Let's talk about silver, and why what you're seeing right now is not a breakout. Traders, investors, and market watchers are buzzing with excitement, charts lighting up, speculation rising, and everyone wondering if silver is finally breaking out to new highs. But the truth is, although prices have moved, what we're seeing is more of a fake-out than a true breakout. I'll explain why this matters, what the data tells us, and what you should be paying attention to going forward. Silver has historically been a commodity that attracts intense speculation. Often labeled poor man's gold, silver is a physical asset with industrial demand, jewelry demand, investment demand, and market dynamics that differ significantly from gold. But before we get into technical chart analysis, it's important to understand the fundamentals that are shaping this market. Over the last several months, silver prices have seen intermittent spikes. Traders looking for volatility have jumped in, hoping for a major break above long-term resistance levels that if breached could signal a real breakout. However, this early movement was not confirmed with volume, a critical component of any breakout scenario. Without strong volume, price moves can be traps. These traps lure traders into positions just before the market reverses. So what exactly is a breakout? In the simplest terms, a breakout occurs when price pushes above a defined resistance level with strength, often measured by increased volume, momentum, and follow-through price action. A true breakout shows conviction. Traders want to buy at higher prices because they believe the next leg up is real. In contrast, what we're seeing now lacks that conviction. Price has flirted with resistance, it has spiked, but it has also retreated. That's classic indecision or fake-out behavior, not breakout behavior. Let's dig deeper into the charts. On the daily time frame, silver's price made a push toward a key resistance zone, a zone that has capped price multiple times over the past year. When price hit that area recently, buyers stepped back. We saw wicks on candles, indicating rejection. If the breakout were real, we would see clean closes above resistance, ideally with expanding volume. Instead, we got weakening volume and candles that closed back inside the range. That's not a breakout. Now let's look at the weekly time frame. From a higher perspective, silver is consolidating within a long-term range. Ranges can last for years. What matters is how price interacts with range boundaries. What we're seeing right now is price testing the upper boundary, yet not breaking through with authority. And without that authority, it's premature to call this a breakout. Part of the reason this is happening is that macroeconomic conditions are uncertain. Interest rates, inflation expectations, and global growth dynamics influence precious metals differently. Gold typically benefits from safe haven demand, while silver has the added variable of industrial use. At times when industrial demand weakens, silver can falter even if gold is strong. Another key factor is market sentiment. When traders believe that it's about to break out, they pile in prematurely. That creates short-term rallies, but once other traders recognize the lack of true momentum, selling pressure increases and prices retract. In silver's case, we're witnessing precisely that phenomenon, speculative interest driving temporary spike, not sustainable breakout. A real breakout needs three confirmations: price closure above resistance, high volume, and momentum carrying price higher in successive periods. Until we see all three, this remains a test of resistance, not a breakout. And testing resistance repeatedly without breaking often weakens the move, making a reversal more likely. It's also important to remember that the commodities markets aren't isolated. Bonds, equities, dollar strength, and global risk appetite all play into silver's performance. For example, if the US dollar strengthens, commodities priced in dollars including silver can appear weaker, even if global demand is steady. Right now the dollar is relatively firm, which acts as headwind for precious metals. That's another reason this is not a breakout. Some traders are comparing this move to past breakout periods. And while history can be informative, markets change. Informal comparisons can mislead. The important thing is to identify objective signals. Right now those signals aren't present. What we have instead is a asterisk false breakout, a fake-out, characterized by price reaching a high but failing to sustain above the crucial resistance zones so many are watching. Let's talk risk. If you enter a long position expecting a breakout that doesn't materialize, you're risking a pullback that could erode your capital. Smart traders use stops, position sizing, and risk management to protect downside when the market sends mixed signals. If you're long silver right now expecting breakout continuation, ask yourself, do I have evidence of a sustained move? And if you don't, reassess. Markets are emotional, and fear of missing out, FOMO, can drive irrational decisions. In a crowded trade, where everyone expects a breakout, there's often less room for growth. That's because much of the buying has already occurred before the breakout attempt. Without fresh buyers stepping in at higher levels, markets stall. This brings us back to the key message. This is not a silver breakout. What we're watching is resistance being tested without adequate confirmation. Not enough volume, lack of follow-through price action, no clear sustainability. Until these elements align, this is a test, not a breakout. Now I want to address what could turn this scenario into a real breakout. First, we need strong volume, especially institutional volume, pushing price above resistance. Second, multi-period candle closures above that level show conviction. Third, Fundamental drivers such as robust industrial demand or significant macro shifts could push price higher in a sustainable fashion. You should also monitor related markets. For instance, gold's behavior often influences silver. If gold breaks out on its own strength, silver can follow. But if gold stagnates, silver usually underperforms. So watch correlations. And for those tracking currency markets like the Iraqi Dinar and the IQD rate, this matters to you because global currency fluctuations impact commodity pricing. Commodities like silver are priced in dollars, and when global currencies weaken or strengthen relative to the dollar, demand dynamics shift. With talk of Dinar RV speculation and traders looking at currency updates, understanding how currency and commodities intersect is vital. Although some investors look at currency revaluation as a catalyst for inflows, it's not a direct driver for silver breakout, but it does influence global liquidity and demand for precious metals. To summarize, price movements that look like breakout attempts can be deceiving. Without volume, momentum, and confirmation above key levels, these moves are likely fakeouts. Silver may still break out in the future, but right now, this is not it. If you're trading or investing, base your decisions on evidence, not hope. Listen to what the market is telling you, not what you want to hear. That's the only way to navigate uncertainty with discipline. Thank you for watching. If you found value in this analysis, share your thoughts in the comments, and let's continue to watch these markets together. Keep learning, stay patient, and always trade with evidence, not emotion.